back to It's Your Move, where we talk about all things real estate, including where I work and live in Galveston, Texas. I would like to talk about mortgage lending today because there seems to be some misunderstandings, some myths, some misinformation, and homebuyers need to have the 411 on this. They really need to know a little bit more about what goes into the mortgage lending process. So I've got about 5 crucial insights for homebuyers that'll help out with that. And we all know that, securing a mortgage is the lending part. Securing that lending is an essential part of the home buying journey. And so the more you know about the process and the options and you have the real information, you're going to be so much better off. So let's just dive right into this. And as you may already know, credit scores matter a lot. So we'll start there. Number 1, credit scores. It's the cornerstone of any mortgage lending process. Lenders use that 3-digit code, 3-digit number to assess your credit worthiness. And a higher credit score generally translates to a more favorable loan term for the buyer. A higher credit score is really crucial. So you get favorable loan terms, lower interest rates, all kinds of perks, and it kind of opens some doors for you. Before applying for a mortgage, check your credit score for any discrepancies and work on improving your score if necessary or correcting any errors should that be the case. Make sure you check your credit score. The second thing is your down payments and your loan to value ratios. Also very important, the down payment is the initial amount you contribute towards the purchase of your home. And that's very important because some loans require a certain amount, certain percentage of down payment, so that's very important. While there are low down payment options available, a larger down payment can lead to lower monthly payments and potentially even a better interest rate. So understanding the loan to value ratio is also crucial. This ratio does represent the percentage of property's value that you're financing through the mortgage. The lower the LTV or loan to value, the less risky the loan appears to lenders. So it makes them comfortable. So you want to have that lower loan to value ratio. So you got to learn more about that. Let's talk a little bit about fixed rate versus adjustable rate mortgages. Adjustable rate mortgages are also called ARMs for short. These are the 2 primary types of mortgages that you will encounter as a buyer. A fixed rate mortgage offers a stable interest rate that remains unchanged for the entire term of the loan, which is great. This provides predictability and, knowing what your monthly payments are going to be. On the other hand, if you have an adjustable rate mortgage, it typically offers lower initial interest rates, but they may adjust, as the name suggests, periodically based on the market conditions. It's important to carefully consider your financial situation and your risk tolerance in deciding which of the two you would like for a mortgage. Let's now talk about pre-approval versus pre-qualification. Those get interchanged a lot, and they shouldn't be, and maybe misunderstood a little bit as well. While you often, like I say, used interchangeably, the terms have 2 different implications. Pre-qualification is a preliminary assessment of your financial situation based on information that you provide to the lender, while a pre-approval, on the other hand, involves more thorough evaluation, including a credit check and a verification of your financial documents. So a pre-approval letter carries more weight and demonstrates to the sellers that you're a serious and qualified buyer. I always tell my clients it's very important. I would much rather have the pre-approval because that gives you, if you're in a multiple offer situation and you have a pre-approval letter, you're going to be sitting pretty and looking better than a lot of other people who may only have a pre-qual letter, okay? Pre-approval is better than pre-qualification. And finally, closing costs and additional fees. Sometimes we don't think about the additional cost. Read the fine print. What's the extras? You got to consider everything. In addition to the down payment, there are various other closing costs associated with the mortgage process. These can include fees for appraisals, inspections, title insurance, and origination charges from the lender. It's important to budget for these costs in addition to your down payment to ensure a smooth closing process. You want to make sure that you have enough money to fund, everything involved in the process in your transaction. So as you can see, navigating the world of mortgage lending, it can seem complex, but with a solid understanding of some of the key insights here, you'll be more prepared and better able to make an informed decision. And remember that you can always seek advice from a reputable mortgage broker, a mortgage lender, your real estate professional that you're using. And since you'll be armed with that knowledge, you'll be well on your way to securing a mortgage that will set you up for success in your home buying journey. So happy house hunting, and I hope this helped you. Thanks for watching, and remember, it's your move.